up, you guys? Welcome back to my channel. In this video, I'll be diving into a fundamental aspect of securing your financial future, building a solid investment portfolio. Whether you're a beginner or looking to refine your investment strategy, this guide will help you understand the essentials of creating a diversified portfolio that builds to last. So investing can seem intimidating, but it doesn't have to be. The key lies in understanding how to spread your investments across different assets, a concept known as diversification. Think of it as not putting all of your eggs in one basket. So to describe a little bit of diversification is about minimizing risk by investing in various assets like stocks, bonds, and cash across different sectors and markets. It is pretty much your shield against the ups and downs of the markets. So as you can see right here, the pie chart is pretty much describing how you should invest, pretty much make your diversification of your portfolio as of stocks, bonds, property, and cash. So the portfolio is a spread of investments that a person, company, hedge fund, fund manager, or financial institutional owns. So it's pretty much the value of each asset or financial instrument in portfolio that determines its risk to reward ratio, which is also referred to as their asset allocation. So the long-term goal of every investor is to get the highest returns possible, which is very understandable. Anyone that wants to invest wants to make the best returns out of their investments, if it comes for retirement, if it comes for a short-term, long-term investment, but also by minimizing their risk. So the typical portfolio should have a good spread of stocks and shares, bonds, and cash, and equivalents that which you can also consider as gold or oil, or depends on what you exactly are looking into. So the asset allocation is pretty much the cornerstone. So imagining your investment as slices of your pie. You want a well-balanced pie, as you can see in this chart right here, with different slices representing various asset class. So stocks, bonds, cash, and even alternative investments like real estate or commodities each play a role. Their goal is pretty much to balance the risk and reward according to your financial goals and risk tolerance. So as you can see, like if you want to go for real estate investing, real estate can be a lucrative move as long as the properties are in the right areas. Again, when you invest into real estate, it's pretty much ideal to invest into areas that are pretty much higher margins, areas that are very, you could say, very friendly compared to, like, you could say, other or location. Location is pretty much key to any investment. So if you invest into any real estate, it's always good to utilize all the different types of scenarios of what this property could bring to you. If you want to rent it for Airbnb, or if you want to make the investment as a flip, you buy it, you renovate it, you make it look much more pretty and resell it. That's also a great investment also to do. If you talk about to buy to let, it's pretty much a term that refers to a purchasing property for the purpose of letting it out to a tenant, which is pretty much what I was discussing before. Buy to let investors buy properties and make the money from a rent paid by the tenant. These properties can either be purchased outright or with a buy to let mortgage. So if you say, like risk management, it is pretty much the steering wheel of your investment journey. Understanding and managing risk is crucial. Your risk tolerance determines how much risk you're comfortable taking on. Lowering the risk investments like bonds may offer stability, while high risk ones like stocks might bring higher returns but more volatility. So how do you get started? Let's break it down into like 5 steps. So let's talk about the first step, like to define your goals. What are you investing for? Are you trying to invest for your retirement? Are you trying to invest for your short-term goals? So of course you consider retirement, a house, or maybe your children's education is pretty much concept goals that you could really utilize to say that you really want to invest to make something for your kids' future, for your own future, for any other future. is very, very important. That's the number one great step into defining your goals. When we consider step two, when you assess your risk tolerance, like how much risk can you handle? There's many investors that invest pretty much, you could say, 15, 20, 30% of their income. Some people are less risky and they want to take only, say, 5% of the income, and they use that for every time of pretty much mixing it up if they want to do as American stocks or the bonds, or pretty much even if you want to go to foreign exchanges, like you could say an Asia exchange, the London exchange, the German exchange. So as you can see, like a risk-seeking investor will pretty much do the opposite by owning fewer bonds and making shares. But there's also normally a rule of thumb: when a potential short-term rewards are greater, so are the risks on that. And when you allocate your assets, you pretty much spread your investments across various asset classes based on your profile. So choose your investments, select the specific assets or investment products that fit your strategy. Like I mentioned before, if it's gold, you could also do oil. If you want to do cryptocurrency, many people like to diversify if it comes to different type of asset classes to see what their margins would be if they want to make higher returns or short-term returns, considering the volatility of the markets. Many people do that to check everything out before they do the investment. And you also, very, very important, is monitor and adjust. So you would regularly review your portfolio and make changes if needed to stay on track. So, building a solid investment portfolio takes time and patience. It's about the timing in the market, but the time in the market. By diversifying smartly and managing risk wisely, you're setting yourself for a stronger financial future. So as you can see, do not overextend yourself. If you do not have millions of dollars, many investors that they start off again maybe with $1,000, $200. Depends if it's pounds, euros to fall back on. Just be careful not to overextend yourself. Don't go over the limit and expect that, okay, if I invest 5,000 today, I'm gonna be a millionaire within the next 1 year or 6 months. You do have to always adjust and adapt to pretty much how the markets regulate, especially when it comes to news. So, like I said, if you're investing with the aim of having an auxiliary source of income as your main business, particularly if you run a smaller operation, consider the outgoing payments and projections of that venture as a priority. So if we start talking about, consider your financial goals. As you can see, this is very, very important. What is the size of return of your investment needed? Do you want to spend a lot of money? Do you want to make a lot of returns? How soon do you want to make the return on your investment? What milestones do you have and you want to hit along the way? Do you want to do a long-term investment and periodically or quarterly you want to take, say, 10% returns for this time, 20% returns in that time? So it's very important to understand what is your mindset. What do you really want? Like, what is your current financial situation? Like, what can you afford to invest? Like I mentioned many times, don't overinvest because, of course, markets fluctuate in regards to what the volatility or if any, in regards to any financial news that anything changes, like if it comes to dividends for stocks, many people invest in those stocks just to get those dividends. So you have to also consider a lot of those options and also how to deal with your financial setback. If your investments don't pan out, do you have an emergency buffer? Like there's always that rule. If you do an investments, make sure you also do pretty much risk management, understand of what you wanna put out. Don't overinvest, don't underinvest. If you see that the money that you have that you can see as a potential loss, make sure you also do have an emergency buffer. It's very, very important. So pretty much the investment portfolio refers pretty much the assets owned by individuals, and the components of a strong investment portfolio encompass pretty much, as we can see right here, the diversified. So we can say the diversification, the spreading investments across various asset classes, which I mentioned before, stocks, bonds, and cash. and market reduce vulnerabilities to economic shifts or market trends. Something very, very important. So, like an example is owning shares in different industries or countries, like I mentioned before. If you go to the London Exchange, the Asian Exchange, or the pretty much the Berlin Exchange or the Swiss Exchange, it's very good to actually diversify in one sector or region. You're going to consider the balanced risk reward. So aligning the investment risk with objectives and risk tolerance. So choosing higher risk investments for long-term goals, but lower risk ones for short-term needs. Very, very important to balance exactly what your goals are and what your risk will be. So of course, the riskiness of your investment should be in line with your objectives and your risk tolerance. And then when we come to cost and tax efficiency, is pretty much maximizing ownership costs and taxes to preserve returns. So example be opting for a tax efficient investment vehicles or understanding tax implications before selling assets. As I was mentioning, it's important to keep this cost of owning assets to a minimal to avoid your expenses eating into your returns. Similarly, you want to minimize the taxes paid by being aware of how gains and losses are taxed and a deduction available. And then we come to the simple and easy to manage or the simplicity of in management, comprehending each portfolio elements proposed and its suitability for your investment goals. So understanding the reasons behind holding certain assets class and how they contribute to your portfolio. So again, it's like you have to understand the purpose of every component of your portfolio and why the asset represents a good investment for yourself. So as you can see, if you want to build an investment portfolio, there's many different type of steps. You can also, what are your goals in mind? You have to answer these questions. What's the size of returns on your investment needed? How soon you want to make the returns of your investment? How do you want to deal with your financial setbacks? So you have to always have steps to constrict an investment portfolio. So pretty much define the financial goals. So pretty much articulate the purpose behind investing, considering returns needed, timelines, current financial standings, and plans for financial setbacks. So of course, for example, saving for retirement or purchasing a home within a specific time frame. We also want to consider the asset risk tolerance, evaluate the comfort levels with potential investment risk based on wealth, investing experience, and goal timelines. So to consider one will be assessing whether comfortability with high risk investments or potential for higher returns, which is very hard to determine. We have to always check on, chart patterns, Fibonacci's, return of investments to see exactly what you see as more of to assess your risk tolerance. Or you can also allocate assets within risk tolerance by creating balanced mix of asset classes like stocks, bonds, and cash. So align with the risk comfort so you don't have to worry about losing too much of your investments. So if one investment went lower and you have bonds and those investments went higher, you're pretty much leveled out. You're not losing so much. You're pretty much balancing your portfolio with a 60% stock and a 40% of bonds, or adjusting based on the liquidity needs. Or you select investments, determine specific assets, allocation percentages, and diversification strategies. So choosing between the individual stocks, managed funds, or ETFs based on risk preferences, and also build and monitor regularly, pretty much review your portfolio performance, costs, and returns, consider the adjustments. If you pretty much, of course, if it's not going to meet the objectives of yourself, so if you're not, you have to rebalance be rebalancing by shifting funds between assets or selecting different investments products for better performance. So maintaining a coherent investment portfolio means ensuring it suits your risk appetite and aligns with your financial aspirations while being adaptable to changing market conditions. So if you want to consider further considerations, So you could do a lot of research and strategy. So of course, like we discussed many times between the stocks, bonds, cash, alternative investments. We discussed also real estate, commodities, cryptocurrencies, and also NFTs. Very, very good. And of course, you have to consider in choosing which investments you prefer to use. So when you consider like what is your goals and time horizon, are there short-term goals, long-term goals? Pretty much you can say medium-term goals. What are your pretty much your goals of what you want to pursue in regards of what you want to invest into? So if you look at the long-term outlook, so this is something that's very, very important. It's pretty much continuously monitoring your portfolio's performance and adapting to changing pretty much your circumstances. So rebalancing or cost efficiency or effectiveness is pretty much adjusting the asset allocation periodically to maintain desired risk levels. As we can see, pretty much long-term goals are pretty much ones that take 5 years to reach. And if you consider the adaptability, being open to adjustments based on changing personal circumstances or market conditions. So there's many type of things you have to really consider when it comes to different type of circumstances. If you want to, you'll also consider seeking advice from financial advisors or experts. So complex strategies or objective insights. It's also very, very important. Pretty much you have to, for complex strategies, especially for inaccurate investment instruments or sophisticated portfolio structures, or getting an unbiased view and tapping into specialized knowledge. So pretty much remember that constructing and maintaining an investment portfolio is a personalized journey. Continuously educating yourself on different investment options, staying updated with market trends, and being adaptable are key traits for successful portfolio management. So as you can see, select your investments, or if you want to consider create your allocation diversity, monitor, rebalance, and adjust. Very, very important. There's also a few extra things to consider for risk management. So if you consider risk management, it's pretty much hedging strategies or scenario planning. So if you explore hedging mechanisms or strategies to mitigate potential losses during market downturns, or if you talk about scenario planning, prepare for the various scenarios that you never know what could occur, and have a contingency plan in place for unexpected market events. And it's very important to have behavioral discipline. So emotional discipline is pretty much avoid making impulsive decisions based on market fluctuations or short-term trends. I've seen this many, many times. Many people that I worked with, a lot of the people always wanted to say that if they invested, let's say we invested in Apple, Apple went to 10, maybe 15% returns in 2 months. They were expecting it was going to go maybe 40 to 50% in maybe 6 months, but it didn't really turn out to be that way. So, and they pretty much got very emotionally involved, and they were anticipated that the market's going to turn around, and they were going to hope that they're going to make higher returns. This is the only thing that you always worry about investments is always the fear and greed. Never invest more than what you can afford, but also be careful of what you invest into and do your research on it, because there's many different asset classes out there nowadays. There's many good returns. Watch, of course, news, pretty much educate yourself, learn about the investment strategies, financial instruments, and evolving market dynamics, or also lifestyle changes, portfolio adjustments like life events, reevaluate and adjust your portfolio to accommodate major life changes. Like we could consider life event is pretty much to reevaluate and adjust your portfolio to accommodate major life changes like marriage, childbirth, career shifts, or inheritances. Also, think about the cash flow management is also pretty much optimizing portfolio to align with changes in income, expenses, or additional sources of income. So there's many different types of things you can really utilize. One could be tech tools and automation. Is pretty much portfolio management tools utilizing technology for portfolio tracking, analysis, and automated alerts for rebalancing or performance updates, or automated contributions. Set up automated contributions to your portfolio at regular intervals to benefit from dollar cost averaging. So, like I said, and also the main, very, very important is pretty much the community engagement and networking. So, if you put yourself in investment clubs, you engage in investment clubs or communities to share experience, great, gain insights, and collaborate on potential investment opportunities, or is also pretty much professional networking, build relationships with financial professional advisors or mentors for guidance and expertise. So the ongoing management for an investment portfolio involves a dynamic process of learning, adaptation, and informed decision making. By staying proactive, continuously reassessing strategies, and embracing new opportunities, you can optimize your portfolio to better suit your evolving needs and market conditions. So that's very, very important to really consider on. And like I said, pretty much we will discuss, like, as you can see, the book. I have a book that's pretty much out there on my website at trademaster.at. It's a very good knowledgeable book when it comes to different type of insights, psychological hurdles, building a solid foundation, technical analysis, trading strategies. This is a very, very in-depth analysis trying to help you guys understand, help you, build a great foundation for your investments, to help you actually go through emotional hurdles. So this is something I would really, really consider in purchasing. Right there, it's pretty much for $7.99. It's a PDF version. You can also buy it on Etsy. It's also a PDF version. It's a little bit cheaper. It's actually $5.99 on Etsy. You can do it on Etsy.com. Same title, same name. And then also on Amazon. If you want to look at Amazon, you get the paperback copy where you can have it physically and you can read through it. It's very great in-depth analysis and a comprehensive guide, pretty much of like how the journey of a master trader, how many years of the experience I made, and the decisions I had involved into trading. It's very, very knowledgeable. So, like I said, in conclusion, building a solid investment portfolio requires the careful consideration of your investment goals, risk tolerance, asset allocations, and risk management strategies. By following these principles, you can create a diversified portfolio that could potentially lead to better returns over time. So don't forget to like, subscribe, and also turn on the notification bell for next upcoming videos. Don't hesitate to provide any comments in the comments below, and then see you guys in the next video. Thank you so much.